Hello friends, my name is Pinaki and welcome to my channel Fintech Logics. Today we will extend our 4 quadrant method to the next age group, which is age 40 to 50. I have already given the previous videos on the different age group and also the introduction. If you have not seen that, I would recommend you to view that. I will also provide the link here. So let's begin. Now we are talking about age group 40 to 50, and I will categorize them as medium risk taking group, because looking at the early retirement at this point of time, 50 to 55 would be the major age for retirement, and based on the different age groups. So if you are already in 46, 47, their horizon is also less. So that is why I'm calling this as a medium risk taking group. Now, high corpus, definitely we have already talked about a horizon of 10 to 15 years of investment, regular investment. So your corpus would be pretty high. The horizon should be medium to long term in terms of your investment. Insurance, that's long term, so that's what I'm putting it as long term view, and your liquidation also. Now, what are my different goals at this point of time? So home loan normally would not have been closed in most of the cases. So home loan would be definitely there. So some portion of my income would go for home loan. Daily course would be already there. Marriages, I'm negating it at this point of time, looking at the normal scenario. Kids education would have increased. So definitely somebody should consider a increase in kids education by this point of time, because the kids should have entered the higher education by this time. Travel purpose, as we discussed, I'm keeping it common for all the age groups. Rainy day savings negating, and I'm putting it a regular investment habit. Somebody should be investing in regular investment from the regular monthly income. Now, strategy is definitely same as 30 to 40, with very less focus towards liquidation, and all other things like investment, credit and insurance should be intact. For that, instruments, if you look, there is slight variation here, that PF, VPF with employment, it would go on. Rather, somebody should be looking at reducing the VPF portion, because it would have already gained a lot of amount. But PPF would have actually reached its maturity period. So normally we have a maturity period of 15, and then it can go up to 20 years. So there is a possibility that in this group your PPF would have been matured. So we'll have to think of some alternative investment, the amount what was going for our PPF. ELSS, you can still make it. You have whatever existing ELSS you would have for next 4 to 5 years. Definitely somebody should consider to invest till maturity. Equity mutual fund, the proportion of equity mutual fund and the debt mutual fund should be changed. So previously, suppose in 30 to 40, your proportion was 80-20 for your equity and debt mutual funds. Now we should be considering probably a mix of 70-30 or 50-50. Nothing is wrong actually. So based on individual risk appetite, somebody should think of reducing the equity mutual fund and increasing the debt mutual fund. At this point of time, I would also recommend fixed deposits, because we also see a lot of variation in debt mutual funds, not all, but certain debt mutual funds. So rather than investing in debt mutual fund, probably liquid funds we can move towards. Lower medium term liquid funds also would suffice the need, which will be slightly better than FD rate, and that can give us a little more returns. And somebody can also think of FDs in banks, which will be definitely interest rate is less, but this is definitely secured. I would advise not to go for cooperative banks, rather with nationalized banks, FDs. Health insurance. So health insurance premium, we have already talked about in 30 to 40 age group. So the same thing should go on. So normal health insurance plus top-up insurance, or normal your employment related insurance plus your health insurance, extended health insurance can also be taken for this period. Credit protection insurance is subjective. If you have a certain percentage of home loan pending, then you continue this. Otherwise, if your home loan amount, your EMI amount would have been pretty less, covering only principal, and probably that can be met from your regular income, then you should consider closing the credit protection insurance, not to have additional insurance expenses. At this point of time, people make a lot of mistake by increasing the exposure of insurance in form of child insurance or in form of term insurance. Normally, I do not recommend taking additional insurance if it is if there is nothing or there is no liability to back. So that is why I keep my investment and insurance separate. Specifically, if I have a single income category, and then term insurance can be considered, or if I have a sufficient big enough liability to cover, then only I would advise for term insurance. Otherwise, LIC insurances can never be thought as an investment option. They should always be kept separate. So this is what the skeleton for 40 to 50 looks like. I hope you enjoyed the video. Thanks a lot for watching.